G'day Fools, I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia, and I'm back with another Motley Fool Stocks in Focus video. We release these every Friday afternoon, somewhere between midday and about 4 o'clock, generally speaking, but if you subscribe to the channel, if you hit that notification bell, you'll know exactly when they're released because they'll pop up on your browser or your phone, whatever device you're logged into YouTube on. So make sure you do that. Do hit that subscribe button for me, and you won't miss this or the next one when we bring you another video. It might be a stock of the week, it might be our favorite investment books, it might be a media appearance, or it might yet be one of these stocks in focus videos. And with no further ado, this week we're talking to Ed Vesely. G'day Ed, how are you, mate?
I'm doing pretty well. How are you?
I'm very, very well. We're going to talk this week about a company called AMP. And when I say that, I don't expect it to be a surprise to anybody. Everybody knows AMP, or at least everybody used to know AMP, mate. When I was a kid, there were only two companies that I can recall had the arbitrary title "the" in front of it. We used to call BHP the BHP. Your old man worked at the BHP, or worked for the AMP. And it was one of those two businesses were just so big, so dominant, so ubiquitous. The time putting the word "the" in front of it made it somehow more familiar, more friendly. We all knew it. We all knew what it was. We all knew what it did. And back in the, I'll say early 80s, I won't age myself too badly, this was probably the only national name. Is it fair to say? Maybe Commonwealth Bank. One of the only national names in finance. It was the top dog. It was the business everybody knew. The AMP salesman was a pillar of the community. And yet here we are, mate, in 2021. The share price, I checked, is down 93% in the last 20 years. That's a remarkable fall from grace. I will ask you a little bit about what's caused that, and I will ask you to speculate on whether this price is cheap enough to tempt even Ed Vesely, the man who likes value when he finds it. I'll find out if it's going to be cheap enough for you. Before we get into that, mate, talk us to us about AMP, the Australian Mutual Provident Society. I think I remember it being called. Tell us the AMP story from then until now.
Yeah, you've got it. AMP. That's the acronym. It's been around a long time. I had to look it up. I didn't realise, but it had been around since, or has been around since 1849. And it became a listed company back in 1998. And I actually do remember that. I think it was George Trumbull who was the CEO at the time. He was a brash American who I think saw the share price list. I think it was around the $20 mark, but it opened up at $40 on the first day, but it's drifted down ever since. So that was something. AMP, well, let's look at it. The company, it's a financial services company. I think you're right, Scott. Most people would know about it. It's got four main segments to the business. So there's the wealth management side of things. That's been quite topical in the recent Royal Commission. That was back in 2018. Yes. I can go into that in a moment, but it's the segment of the company that provides all of the financial advice, and it's got that through aligned and owner-advisor businesses within AMP. It's got platform administration, and that includes SMSF administration, which is becoming increasingly popular these days. There's superannuation, managed investment products, retirement income products, and so on. So all of that provides around 44% of the segment revenue for AMP as at the 30th of June. Right. And then you've got the same sort of business in New Zealand, much smaller, of course. It comes up, I think it's around 7% of total revenue, and it does pretty much the same thing in New Zealand, but it includes products like Kiwi Super, and there's corporate super and so on. And then there's AMP Capital, and that's the investment manager side of things. So you've got the infrastructure, investments in real estate, equities, fixed interest, and so on. And I guess most people who have read the news in the last few years have seen that that's where the source of the problem for AMP has lied. You've got the investment management side of things trying to push their products through the investment advisory network, which has been, of course, AMP aligned and AMP focused. So that's AMP. And then the last bit, which is actually what I think is the jewel in the crown for AMP, and that's AMP Bank. Now, it's interesting. I looked into this. It's actually performing quite well. AMP Bank provides accounts for around 19% of the revenue. But when I look into it, at least up until the most recent results for the half year, AMP Bank was providing just under 41% of its total profit.
Wow. Okay.
So I think that tells you how good AMP Bank is, but I think it also tells you how poorly the rest of the business has actually performed.
Yeah.
So so that's basically it. Look, the three major parts to it are AMP Capital, Wealth Management, and AMP Bank. But you could say, as I say, AMP Bank is doing quite well all up. So that's AMP today in a nutshell.
Nice, mate. Let's go back to the business units because there was a time when the AMP salesman was the AMP salesman, and you would go and buy an AMP insurance policy, or you'd go and get some AMP financial advice from the AMP salesman. And I think back in the day, we all kind of knew what we were getting, right? You were going to get an AMP product because you went to the AMP man, and that was how it was done. To some degree, I wonder whether circumstances didn't change, and AMP simply failed to change with it. The requirement for financial advisors to be suddenly independent, to give genuine financial advice, not just product sales, seems to be, at least in my reading of history, what kind of tripped AMP up. If they'd remained AMP salespeople, you knew you were going to get sold an AMP product. You might buy one or you might not. A bit like the bank tellers, right? You go to a CBA and the bank teller says, hey, would you like to buy this? You don't expect the bank teller to say, would you like this AMP deposit or this NAB mortgage? You figured the CBA teller is going to offer you a CBA product. That was kind of the old AMP story. And as financial advice moved on, I kind of feel like they probably got caught between two worlds. They wanted to keep selling their own stuff because it's really profitable, right? If you can sell your own things at, I won't say inflated prices,
Yeah.
I'll just say at high fees. But you also want the financial advice business. You kind of want to be both, and it's very, very hard to be both in this world. Is that your sense? They just simply fell between trying to be both and not really managing to do either?
Oh, I think so. I mean, there's obviously with the Royal Commission that released the report, I think in early 2019. You could see that there was a lot of bad behaviour within the business, but I think that's just a
Yes.
reflection of what could you say? It's just there's been a lot of patterned and routine behaviour with the company. They've become so used to doing what they've been doing. I think it's created a lot of complacency within the business. There's been a lot of
Right.
management change within the business in the last 2 years as well. So I think today the management team are trying to do what they can to try to fix that, but with the increasingly stringent requirements and regulatory requirements for financial advice, it has been caught short, and it's trying desperately now to restructure those businesses and try to see if there's some growth coming through, which might come through the next 18 months to 24 months. But it's a tough job, and we just have to look at the revenue growth from, say, 1999 through to 2017. And I choose that date simply because that was before the Royal Commission had started. And what we see is that back in 1999, when it became a listed company, the revenue came in at around $27 billion. And today, 2017, that had fallen to around, I think it was around $18 billion from memory. Now, that was a 33% decline over 18 years.
Yeah.
And since the Royal Commission and since the bad behaviour has come out and since everyone's become, I suppose, more familiar with the brand, but for all the wrong reasons, the revenue has fallen subsequently another 80% since 2017 down to 3.4 billion. We're still talking big numbers, but geez, the numbers are much smaller than where they used to be.
It's a fascinating story too, mate, because... Okay.
I was just going to say, it's just been in a world of pain in the last 3 years, especially.
It is a fascinating story, mate, because if you think about the AMP story, I'm going back again. I'll kind of hark back to it was literally called the AMP. I don't know if you called it your house the AMP, but BHP was the BHP and AMP was the AMP. Probably because it was the Australian Mutual Provident Society originally, so I probably kept the prefix because that just kind of made sense before acronyms became all the rage. But it was, to my mind, mate, to my memory, the preeminent name in financial services in Australia. If you just told me in 1980 what was going to happen with financial services, the boom in the dollar value, the number of customers, the amount of fee revenue being earned by the financial services industry today, I don't know. I would have sold the house and bought AMP shares, but I would have gone close because you think, hang on, these are the big dogs. These are the guys who are poised. They're in wealth management. They're in funds management. They're in insurance. I don't know, mate. I reckon I probably wouldn't be alone either. 99% of people would have said, well, obviously AMP is going to make a lot of money. And yet they've just, and I'm not even sure I know the answer to this question. Maybe you don't even know the answer to this question, but do you have a speculation as to how they managed to screw this up so incredibly badly to go from a position of the incumbent, the heir presumptive? We would have assumed they were the guys who would be today. They might have even shadowed the big banks. If you think about how big it could have been with a banking business, as you say, with financial services, financial advice, funds management, these guys could have been the Citibank or the HSBC. I don't know, of kind of at least of Australia, surely.
Yeah, I agree. I mean, look, the banks, its main competitors, they haven't done exactly that well either. I mean, the underlying growth in banking and superannuation in funds management with those other businesses like the National Bank and MLC, for example, have also been quite flat. And that's why you see National Bank offloading MLC and Commonwealth Bank doing the same with Colonial. But
mm, mm.
I think, yeah, AMP has done really badly. And in terms of the
Yeah.
reasons why, I can't really put an answer on that. I know competition is a part of it. It had a fantastic brand. To some degree, it still does have a
Mm,
good brand if we can, I suppose, give it some sort of leeway. But look, it's a very hard thing to do given how bad the reports were out of the Royal Commission. I really can't put a finger on it other than to say that I think it could be a combination of, look, increased competition within banking and financial
mm,
services more generally. You've got overseas banks
mm,
here, you've got a lot of fund management, you've got a lot of smaller banks on the side trying to nip at the heels of the larger banks. But AMP has done, I think, pretty badly. And I think when you see revenue falling so drastically and so consistently since 1999 and profits just
mm,
not growing anywhere. In fact, profits have actually, oh, they've been up and down, sure, from year to year, but they've been drastically going downwards over the last 2 decades.
mm.
It's just been a terrible ride for shareholders. And I guess when we espouse long-term investing at the Motley Fool, we do say we love to invest in companies for 5 years or more. And
Yeah.
if you can invest for 10 years or 15 years in a company, you should do very well. But it is on the
Mm,
proviso that the company you choose is actually a company that's actually growing its wealth for its shareholders. Clearly,
mm.
this isn't the case here. And it's proven to be a very bad thing for shareholders to have held on for so long if they've held on since 2010 or 2005 or beyond
Mm.
that, before that.
Mate, that was
Can't put a
then.
finger on it,
This is
Scott, I'm
now.
afraid.
That's all right. That was
Yeah.
then. This is now. Before we get into that specifically, though, let's go to the Royal Commission. I'm gonna make a statement here, and you're going to agree or disagree. I'm going to say that I think AMP was unduly hated on by the media and the public, not because they were unfairly targeted or by the commission, but because for some reason, and maybe because of the share price, maybe because it was easier, maybe because there was less in terms of other business. I'm not sure they were that much worse, were they, than, say, for example, Commonwealth Bank's insurance business or NAB, who pretty
Mm.
much turned up and were ultra combative, leading to the resignation of a CEO. If I think about that, AMP is the name that kind of bubbles to the top, but I'm not that sure these guys were so much worse than the others. Have they been unfairly, again, not unfairly tarnished in terms of they did the wrong thing, absolutely, but in a relative sense, the other guys seem to have got off relatively cheaply compared to the reputational damage AMP took. Is that a reasonable assertion, or am I being too kind?
I don't know. I suppose you could always compare it to the Commonwealth Bank or Westpac or the National Australia Bank, but I think when you look at the statutory results from the last 18 months, and especially for the period to the 30th of June, the
Mm,
statutory profit is lower, and that's
mm,
mainly because of client remediation costs. So what AMP is
yeah,
doing is, whether it's fair or unfair, they're actually agreeing with what's being imposed on them, and they're saying, "Hey,
yeah,
we are going to pay another $33 million in
yeah. Again,
remediation costs to put things right,"
yeah,
and that's on top of the millions of dollars that have been
yeah,
paid before that in the previous halves. And then you've got another
mm.
$61 million in costs associated with trying to improve or fix this business. So they clearly acknowledge that there's something wrong here. I
Oh,
think,
look, to be clear, I'm not
look,
saying there's
they
nothing
don't.
wrong. I was more just the comparison between
Yeah.
it and, say, the CBA or NAB and Westpac, who've had their own AUSTRAC issues. That's the anti-money laundering legislation. It kind of almost feels like, because AMP is just specifically this business, whereas Combank and others are so much bigger, and their business is so much
Mm,
broader, it seems like this has become just not, again, the penalties are absolutely fair and appropriate, best we know. And for all the banks, including AMP, so everyone got their just desserts. It just seems to me that the investors, the investment community, the public at large, seem to have taken a larger swipe at AMP as a result of what was a fair judgment. Whereas, as I said, the likes of
mm.
NAB and Westpac with their AUSTRAC issues, Commonwealth Bank's ComInsure business, there were some significant, adverse findings, as the Boffins like to say. But we kind of don't think about that when we think about Westpac or AUSTRAC or NAB these days. We kind of go back to the business as usual, or their core banking businesses. It seems like AMP is carrying more of a stench, even on top of the very reasonable and real costs that are being borne to fix the problems of the past.
Well, I think that's right. I think possibly the AMP brand, it's been around for so long, and as you've said, it's been around since we've always referred to it back in the day as the AMP. I think maybe because the branding was so strong, the
Mm,
expectations of the bank and its behaviour by its staff and senior leadership have been quite,
mm, mm.
at a very high level. And I think you could maybe say that the expectations on the banks were lower because we've always expected banks to maybe misbehave. I, again, can't
That's
put a
true.
finger on that. It could
Yeah.
be. It could just be that expectations are lower relative to AMP. But I think AMP was actually the preeminent brand for decades and decades.
Yeah.
And
Yeah.
My dad was buying insurance, life insurance with the company since,
Same.
well, the mutual, since the 60s. And he
Yep.
got his
Yep.
shares in 1998.
Okay.
But it just hasn't done, they haven't met up with the expectations of that brand. So I think, which is a real shame. Look, the most recent results have been quite good. There's been a 57% increase in net profit. That's underlying, I should say. The statutory profit for the half year has fallen because of those costs I'm referring to. But
Right. Okay.
AMP right now is drastically trying to, I suppose, just right the ship. It's a big job. I think if we're going to see them improve, I think if there's going to be any increase in the multiple of this business, then I think you've got to see not just one or two halves. You've really got to see a sustained improvement in the financials, but importantly too, the way that customers and advisors perceive the business as, as being more of an ethically minded business these days. So it's a hard one to say. I think I've also got dogs in the background.
Yeah, it's mine
But
too.
look, expectations for the future on AMP right now. Look, if I look at the four segments with AMP, wealth management, they're actually saying that they expect to see a continuation in falls in margin, and at best a performance flat against the first half. So there's no growth there. AMP Capital is expected to see lower earnings for FY21, so that's the end of December. There's a flat outlook for New Zealand wealth management. AMP Bank, on the other hand, which I have already suggested is maybe a jewel in the crown, it is expecting to see a stronger second half. It's focusing on residential mortgages. It's really sticking to its knitting, and I think it's doing quite well. But anyway, notwithstanding the competitive environment, I think it's going to get a good risk return profile on how it's investing its money there. But overall, it's pretty expensive. If the multiple today is around 30 times, and we're seeing 3 out of 4 of its segments as seeing either flat to falling growth, if you can call it that, in the next 6 months or so.
All right, mate. So let's turn attention to that. Let's try and break down the bull and the bear case separately. You might have given the game away, but let's go with it anyway. Let's make the bull case for me. If you're gonna sort of outline a reason to look at AMP, I imagine a fall from $40 to about $1 at the time of recording it, $1.04 I checked before we came on air. That's a precipitous fall. Now, some people will say, I'm not buying a company whose share price is falling. Others are going to look at that and go, so what if the market's overreacting? Maybe there's some value there. If you're going to make the bull case for AMP looking forward, we can't redo the past. We're not stuck in the past. We only get the returns from now into the future. If you make the bull case for AMP, what would you argue, mate?
Okay, well, the bull case would be that this is a company that financially, operationally, and I suppose from a branding perspective is really on its knees right now. And the PE multiple looks quite high now because earnings are so depressed. And if there was to be some improvement, and let's just say that the management team, and the CEO is fairly new, if she can actually come along and improve this business, if she can stay in the job for starters, and just deal with all of the various stakeholders within the business and outside of the business, if she can actually hang around and do her best to right the ship, it might take several years. You could see that the share price will increase from here, but there is a but, isn't there? I think the risks are so high and the uncertainty is so high is that there's a very real chance that outflows, that is investment outflows in the business, will continue to go in the wrong direction. That's why it's called outflows, right? I think until we see some sort of shoring up of business moving out of AMP, then I think it's probably a little bit too early, despite the very low price. As I say, the multiple's not necessarily low, but the price compared to where it was 5, 10 and 15, 20 years ago is certainly a lot lower. I think when I look at AMP today, I think the bear case is that I think business will continue to move outside of AMP, move away from AMP. You've got, for example, I think I mentioned earlier that there is a fund platform which competes with the likes of Self Wealth and Hub24 and Premium and others and so on. But these guys continue to grow market share and steal business from the likes of the big banks and AMP. And I think there'd have to be some sort of slowing in growth on those competitors, and maybe some of that money, at least the outflows slowing down or reversing ideally. So that has to happen. What else? I think I just think the general breaking of the link between product and advice, that's still happening, and I think that's going to have some sort of negative effect going forward. The fact that AMP products can't be this is maybe a bit harsh, but if they can't be pushed onto customers of AMP financial planners, the profitability could still be lower again. So that aspect to it has to play out. And there's also in July too, I read that there's a new advice service model, which will see more of a user pay service model for customers to pay the financial planners. So that's actually a good thing, but I think it's also going to affect some of the money that could be invested with AMP or AMP financial planners. So I think there's a lot of negativity still towards the stock. And look, there could be a very short-term bounce in the shares, but whether that goes to $1.10 or $1.20, there could be a small gain there. But long term, I'm actually really worried about the strategic positioning of AMP because I can go anywhere for advice. There's a lot of independent financial advisors who are signing up to the likes of Hub24. They can use those platforms. They're independent. They can provide fearless advice and say, this is what we do. We don't have any products or any managed funds to sell you. So that's a good thing. And I think that's becoming more and more attractive. And if the likes of AMP have to compete on price now, and they've got all that baggage with their history through the Royal Commission, I think it's going to be a hard slog for a number of years yet. I think, look, if you're really looking long term, you could find some value here in the shares, but I think short term, and I'm talking 3 to 5 years, some people think that's a long time, but 3 to 5 years, it could take that amount of time to turn around. But look, I think what I would like to see, I mean, right today, you've got AMP, the market capitalisation of AMP is smaller than Bendigo and Adelaide Bank. I checked that it was 5.2 billion for Bendigo.
Yeah.
ARB Corporation is another company, which is an exporter of four-wheel drive accessories, nothing to do with AMP, but its market cap is actually higher again than AMP's. It's 3.8. And the Breville Group, the maker of kitchen appliances and so on, it's also sitting around 3.8 billion, whereas AMP today is $3.4 billion. I personally think, Scott, this might be, maybe many people won't agree, I think that the most value that shareholders can get out of the business today would be if management decide to actually sell off each of the segments, including AMP Bank. They should actually return that capital to shareholders and just wind it up. I don't have any special interests or fascinations for the AMP brand. I just think that there's probably a lot more potential for each of these businesses to be operating under different names. So AMP Bank, for example, could go to another bank, or Macquarie, for example. And I think you could say the same for AMP Capital and so on. But I think each of these businesses do have some value, but I think the way it is, and it's the way it's stapled together within AMP Limited, I know that the company is certainly looking to demerge, and it's removing parts of its AMP Capital business. But I think ultimately it'd be just good to see them all sold off, have the cash in the bank, and then pay it out to the shareholders, and they might get some money back. So that's how I see it. I think it's pretty awful the way it is today.
There you go. I was going to ask you whether you think it'll outperform the market over the next 5 years, Ed, but I reckon I know the answer to that question. So, mate, thank you for sharing with us a summary of the past
no worries.
disappointments of the business we now know as AMP. Maybe for not much longer if Ed has his way. Be sold off, broken up, and the AMP brand maybe not long for this world. Interesting question, though, of course, if it is worth more to other people than AMP shareholders, maybe the shares are actually undervalued. That's one we'll talk about another time. Ed, thank you for joining us to talk about AMP, mate. Really appreciate your insight, your expertise. Thank you for the research you've done to prepare that for our YouTube viewers. All that remains is for me to remind you, we have a couple of podcasts you can listen to. You can check out the Motley Fool Money podcast, and you can check out The Good Oil with Scott Phillips. And as I regularly say, I hate the fact I have to reference my own name in that title, but that was what the boffins at Listener required us to call it. So The Good Oil with Scott Phillips, apparently it made it easier to search for, or Motley Fool Money. You're, of course, on our YouTube channel already, and thank you for doing that. If it's your first time here, or your second time, or your third time, and you haven't yet subscribed, please do that, because Ed will be back sooner rather than later with some, well, maybe a book recommendation, just quietly, maybe a stock of the week where he brings us a company he really likes and thinks you should buy, or another Stocks in Focus video. Ed and all of our colleagues at the Motley Fool are super keen to bring you some great video content. So please do make sure you do like and subscribe to the channel, hit that notification bell. And until next time, on behalf of Ed and the whole Motley Fool team and myself, Fool on.